Um, Let me quickly introduce Christoph before I ask him to do the same himself. So Christoph is one of the two co-founders of Point Nine Capital. It's a Berlin-based seed fund. They've just raised their fifth fund, which is some silly number that's basically 100 million euros. And Christoph and I have known each other for a long time, but I would describe us as not super close, but people, I've sort of communicated on and off with Christoph for, I don't know, 5, 6, 7 years now. We've probably only seen each other twice in person, maybe. But I have to say, Christoph is someone I've always had a huge level of admiration for. And he's sort of something of a role model for me. He's a great investor. He's matter of fact, he's humble, he's helpful. I think he has a very similar ambition to me, which is, to build a genuinely world-class venture firm that just happens to not be headquartered in Silicon Valley. And frankly, I think he's extraordinarily well on his way to that. I mean, he can boast seed investments in Algolia, Typeform, Loom, Contentful, a whole bunch of very, very well-known and successful SaaS companies. So I'm delighted to have him join us. So we're going to try and talk about a bunch of things today. And I think he'll bring a really interesting international perspective to what are often fairly myopic Australian-focused conversations between us. I would be remiss if I didn't mention up top that we are co-investors with Christoph. He led the seed round in Quilla, and we led the Series A in that company. And I'm a little bit embarrassed that it was in that order. But he's also invested in Vend, Marley Spoon, and a couple of other companies in this region. So he's not a complete stranger to our part of the world. So Christoph, thank you so much, firstly, for getting up and doing this at 7 in the morning. Welcome to the AirTree community, and maybe we could kick off just a little bit about yourself and the journey to Point Nine.
Hi, John. Hi, everybody. Thank you so much for inviting me and for the very kind words, John. And it's great to see all of you. I think this is one of the most impressive, largest Zoom grid that I've ever seen, because usually in like webinars or conferences, people aren't on video, but it's actually cool to see so many faces. I've seen a few faces that I've seen that I know. Hi, Tim. I can see you there, Tim Brewer. And there might be a few others. I think Mark from Quiller might be there, but I would have to like paginate. Now I don't know. I can see I think 25 of you, but then there are 6 or 7 pages. So I'll try to scroll sometime during the call. Again, really appreciate you inviting me to this meeting, John, and looking forward to chatting with you and all of you, and maybe trying to answer some of your questions. And I think you gave a good and very kind introduction already about me or Point Nine, and maybe just to I can see Mark now. Hi, Mark. You appeared in my corner here. Good to see you. We're just briefly to add. I think you mentioned like the key data points already. We've been doing this for about 10 years. We're based in Europe, in Berlin, but we're very agnostic in terms of geography, but pretty focused in terms of the sectors and the stage. So maybe that's something to talk about, since John, I think at AirTree, you kind of follow an opposite strategy, right? You're quite focused on your geographic part of the world, but more open in terms of sectors and stage. And I think both approaches have their pros and cons. So very happy to talk about that. Maybe let's see what questions you guys have.
Let's go straight to that, actually, Christoph. I think that's I was going to talk about it later, but I think it's a really interesting thing to start with. So at AirTree, we are, very geographically focused. We're sort of trying to back the best Australian and Kiwi founders that come through, and hope that there are enough generational companies in our region to make that strategy work out. And so far it has. But I have to say, with the world sort of tipped on its head since March, and with everybody operating remotely, I'm I'm becoming more than a little jealous of your, video conferencing first approach for 10 years. But do you want to talk about the sort of geographic agnosticism, but the stage and sector focus that you've had at Point 9? I'd love to sort of hear about the thesis behind that, how you've approached it, and then I'll make fun of you for making a artificial meat investment, which has nothing to do with any of those things.
That's right. Yeah. Well, occasionally we try to prove the rules with the exceptions. Like in terms of our geo strategy, which maybe you could say is no strategy because we're open to investing anywhere. It has just come very natural to us. Like when we started Point 9, Pavel was in Berlin, and I was spending a couple of months on a little island in the Caribbean. Was supposed to take some off after my exit as a startup founder, but that's pretty much when we got to know each other first. So like it took us several months until we met in person for the first time. We've been communicating over the distance for several months over email and at the time Skype, and we were talking about potential investments together, and then ended up making the first investments together in Canada, out of all places. And one of the first ones was actually Vent, which is closer to your corner of the world. And we just didn't really have this idea that we could limit ourselves to companies in Germany or even just in Berlin. Maybe it was because there weren't enough of them at the time, like 10, 11 years ago. We didn't really see maybe enough companies that we liked there, but also we just, I think it didn't really come to our mind that we could focus only on that part of the world. And I think it has served us really well. Like maybe only about 20% or so of our companies are from Germany, and if we hadn't been open to investing in France, the US, Canada, New Zealand, Australia, we would have missed most of the companies that we're very happy to have invested now. I think, obviously there are advantages of being local as well, and you could maybe argue that if a deal is competitive, which is not always the case, but occasionally is the case, then the question is, does a founder prefer to work with somebody who is close by and who they can maybe meet once a week in person to talk through everything? And I think this definitely has advantages, and we try to make it work as well as possible over the distance. But then on the other hand, the fact that we are working so closely with, meanwhile, about 100 Saas companies or 100 B2B companies from all over the world also gives us a level of insight that you probably struggle to get when you say you're investing only in Paris, for example. So we feel that at least in Europe, for us, right? I'm not saying others should do the same or others do it wrong, but for us, the strategy is working really well, and we feel like we were in a good position to compete with funds all over Europe if we have to. I think maybe I can imagine that it's a bit different if we're talking about Australia and New Zealand, just because there are a couple of thousand more miles between that part of the world and pretty much the rest of the world, as well as time zones. So it's just an extraordinary effort for an investor from Europe or the US to come to Australia and or New Zealand to meet founders in person, right? This barrier doesn't exist between Germany, France, the UK. At least in normal times, this is like you can decide to visit any of these places basically you can decide in the morning that you want to be there in the afternoon. So it's become really flat, the world in that respect. But I guess Australia and New Zealand is still a bit of the world of its own, just because it's so far away. But maybe debatable if that's also changing now that the whole world has become remote, at least temporarily.
Yeah, I think it's more than debatable. I mean, I'm talking against my own book here, but I've seen Mark and Dylan talk about, the value you guys have added at Quilla from 12,000 miles away or whatever it is. So it's clearly manageable. And I think, Australian founders are right to look for the best partners kind of wherever they're based. I wonder, you mentioned Canada, and I assume you're referring to Clio there. And Mark told me that you had funny stories about the early days of Clio and Zendesk and that kind of stuff. I wonder just if you could take us on a bit of a trip down memory lane and just talk about sort of how you originated your first sort of set of companies from Berlin back when, you had no right to be on any of these cap tables. It's kind of question one. And then question two, related to this international strategy is, how do you not be the funder of last resort? Like, how do you get comfort that you're sort of seeing the right things?
Yeah, that's a good question. So, I know which anecdote Mark is referring to when it comes to those emails at Clio, which is the story is so funny that the founder of Clio, I think, keeps telling it to everybody who will listen to it or listen to it again, or at our annual founder summit. So the story there was that I at that time, it was actually pre-0.9. My email address was cjanz@web.de, which is kind of like the equivalent of a Hotmail address or an AOL or Yahoo address. On top of that, it's like German specific, so it's even more like mysterious for somebody from the outside world. That I emailed Clio after having found out about the website and the application online, and that email ended up in their spam folder, like basically 2 or 3 times. I followed up a couple of times. It always went into the spam folder, and then like really just by sheer luck, eventually they saw that email because Ryan, one of the co-founders, was on I think a boring customer support call and was using that time to check his spam folder, and then he saw that strange email, which probably looked like it came from a Nigerian prince wanting to wire them some money, and Google probably thought the same. So my email credibility was apparently very low with a German domain and keywords like investment and things like that. But eventually they looked at it, and we had a call, or probably a Skype call at the time, and then it clicked immediately once we had a chance to connect, and then we decided that we wanted to invest, and they were in the process of raising a seed round, and that was more than 10 years ago, and we're still a very happy investor in that company. So the story has a great ending. And in terms of like the risk of adverse selection that you're referring to, I think at that time, like in 2009, the risk was not that significant because it was a really hard time for companies to raise money, at least outside of the Bay Area. Maybe in the Bay Area, there was always more funding available, but in Europe, anywhere, it was really hard, which is also why I was able to invest in Zendesk, because basically nobody in Europe wanted to invest, and there weren't many investors, whether that's angels or VCs in the first place. And same with a place like Western Canada. So they were really happy to talk to anybody who would listen to their pitch. And this has become quite different, fortunately. Now I think there's so much more startup funding available now almost anywhere in the world. But meanwhile, our pitch has also become a bit better. So hopefully we've managed to keep up with that to a certain extent, because now we can it's no longer the Nigerian email, it's a 0.9 email now, and we can mention a few companies that we've invested in, or people have often already heard of us, at least when it comes to Saas. But I would say you're right with respect to companies in the Bay Area. If you're going through YC and you do your demo day, then 200 investors have looked at you already. So if we want to invest and we have a chance to invest, it means that lots of other investors saw it and passed, and that might be completely fine, right? Like we might be willing and conscious and aware of wanting to do something which lots of others didn't want to do because they maybe weren't excited enough or weren't ready to take the risk. But we have to be. This is a bolder decision than like we then have to like assume that we are smarter in this particular case, or that we are willing to take a risk which others are not.
Let me. I'm sort of jumping around, but I feel like it's on theme. Let me jump to Loom, because it's sort of, when you talk about an outbound email to Clio in 2009, that makes total sense to me. And then I imagine that over the course of 10 years, you build a brand and you have some, you get some inbound, but it's for a reason, and you can sort of manage your way through that selection issue. But Loom, and I get, and I want to talk about them, don't get me wrong, but I sort of get why Typeform and Algolia and those companies, like I get how you invest in them. But Loom is a pure US company that presumably had a bunch of US seed funds look at them, and it's a breakout company of this generation. How did you invest in those guys? Why did you invest in those guys? Just tell me the Loom story.
Yeah, Loom, for anybody of you who doesn't know them yet, I'm assuming a fair number of you have heard about them already, or have maybe received some Looms already, or maybe used the product yourselves. It's basically a very simple asynchronous version of Zoom. It also has a similar name, only replace the Z by an L. It allows you to very easily record videos of your screen and the camera, and it's just a really easy way to communicate in a very visually engaging way. And when we did the seed investment about 2.5 years ago, obviously the company wasn't as popular or as hot as it is today. But still, you're right that when we saw it, we had to assume that like other investors who look at this must see the potential there too. And the founders are or were quite young, but they already like one of them already worked as at a VC for a certain period of time. So they also had a good network, and we definitely were assuming that they have lots of options when it comes to fundraising. It was a case where when we saw the product and had a call with the founders, it kind of became clear to me immediately that we have to invest in this company, like no matter what. Like, I mean, usually it takes more time for us to develop like that last bit of conviction. I think there is I think the first impression is always quite important, but in most cases it takes us a couple of weeks to do our work and really understand, or at least try to understand a market. In case of Loom, it was easy. One reason being that it was very early and it was a consumer style product, so there wasn't much market research to be done. There also weren't a lot of metrics. You saw the product and you could imagine that that this has infinite use cases. So we really thought that this is a very special opportunity that maybe we see only once a year or once every few years. And then we decided really, really fast and I think made a reasonable offer and suggested a couple of introductions to between the Loom founders and a few founders from our portfolio, so that they, despite the fact that this also was like a couple of miles in between, a couple of thousands of miles away, that they got a chance to build conviction on us by talking to founders that we've invested in before and taking references. And then we were very happy that we ultimately had a chance to invest. And I think the whole process took only 2 weeks. So the fact that we were so fast to decide certainly also helped, because if we had to compete head to head against Sequoia, then I'm under no illusion that this probably wouldn't have led to us investing.
And I find that such a fascinating answer from you, Christoph, because if I can impose my sort of my observations of you onto you, you've always struck me as incredibly metrics driven. I use your cohort analysis template to this day, but it sounds like Loom was some kind of pure product intuition. Is that fair to say? And if that's true, like, and I say this with the greatest respect, like, how does a guy like you make that call?
Yeah, you're right, and it's a bit funny or weird almost that we think so much about metrics and create all these templates, but for maybe 2/3 of the seed investment decisions that we make, all of this is not very relevant because there isn't enough data to really make a highly data-driven decision. So I would say our understanding of Saas KPIs and cohort analysis and all of this is probably more relevant for when we work with companies post our investments to try to help them focus on the right KPIs and get them ready for the Series A stage, where then an investor like you will look at all these metrics. I think it's maybe even more useful for us on helping a company get from seed to Series A than finding out if it's the right investment for us at the seed stage. Loom did have some metrics, like they didn't have any revenues, and it would take another year or so until they started to charge. There were some metrics that indicated to us that there could be some virality happening, but the data was still pretty spotty and like not very reliable, because just the data set just wasn't big enough. So it was hard to disentangle different influences or impact. So we always look at whatever data there is, but often it's very inconclusive. And then in the end, you look at all the data, but then you still have to decide more based on your excitement about the product or the market and the founders.
I think this is a really good segue into something that at least 2 people, maybe more, are mentioning in the chat, which is what I think is your best piece of content marketing, which is the Saas funding napkin. I think Andy and Kunwar and maybe others have asked for a preview of what the Saas funding napkin looks like in 2020. But I wonder if I could take a step back from that and just get you to, related to this conversation around Loom, right? Like what it takes to get funded by a great seed fund in 2020. And I think you've just talked to that. And then maybe you can sort of speak to what the next rounds look like. And I wonder if I could ask you, maybe it's a separate question, maybe it's the same question. you've made an investment at the seed stage in Australia, which is Quilla. I'd be really interested to hear how you thought about those guys. And at the same time, my content marketing people will get me in trouble if I didn't correct you from calling us a Series A fund. Quilla was a mistake. We should have invested at the seed, but we corrected that mistake at the Series A.
Got it. Good. Well, it's good if you can. That is. I mean, that's actually great, right? If you can correct a mistake, then maybe, well, you pay up. But if the company becomes really, really big, it doesn't matter that much, right?
Yeah.
So it's a bit embarrassing, but we have not yet created or finalized and published the 2020 version of the Saas funding napkin, despite the fact that we've always published one around mid-year in the last couple of years. And the reason is that 2020 is such an awkward year, to be honest. We're really struggling to come up with like the right data or recommendations. And I think there was a time, it wasn't very long, but sometime in March, April, for maybe 4, 5, 6 weeks, it was like everybody was super nervous, right? And it was very unclear what the funding landscape would look like, because, well, almost from one day to the next, there were lockdowns everywhere, and big recession was going to come. So for a couple of weeks, it looked like maybe it would be really hard to raise any kind of venture capital this year. Then people adjusted really quickly over just a couple of weeks, and everybody got used to making investment decisions over Zoom. So it felt like we're almost back to normal already a couple of weeks later. And then what we then saw was that any company that benefits from COVID-19, because it's something with online collaboration, video, or just anything that manages to benefit from this, like can raise at even better terms than they did before. And there were some almost crazy stories of a company like, I don't know, Hopin. I don't know if you're familiar with it. It's a European one, but like they apparently went from 0 to 20 million ARR in a year, and now raised at a 2 billion valuation, like for a 1-year-old company or so. So crazy stuff happening. At the same time, I'm sure other companies are struggling to raise, but we probably know less about them because they are less in the news. So I think the 2020 version of the napkin, once we've done our research and talked to many other investors, might be that it's somehow divided. Like either you are in this category or in this bucket of companies that become really hot for one or another reason, and then you can raise at very high valuations, or you're not, and then in a way different rules apply. So I don't know if there is any kind of rule set that applies to everybody. And obviously it's always been hard to work with averages for things like valuations at seed companies, because there's always been this phenomenon that investors all tend to want to invest in the same companies. They get high prices, and everybody who is not in that top 10% or whatever is struggling. But I feel like this year it's become even more pronounced, and we're still collecting data and making up our minds on that.
Interesting. So a hot or not version of the napkin.
It feels a bit like that, yes. And at the same time, even though it's tempting, I think I wouldn't recommend to founders to try to pretend you are a beneficiary if you're not, right? It just doesn't. By now, you would see it in the numbers if you are getting a COVID boost or not.
Yeah, I totally agree. I would generalize it a little bit more than you, in the sense that I think cloud generally has received a boost. I think there's obvious exceptions
Right.
in hospitality and travel and whatnot. But if you just look at the public markets, I think if you're in cloud in vertical SaaS, you should be on balance better off than you were.
Right. Yeah, that's true.
Question, just coming back to Loom for a second, because Mitch asked a good question, which appeals to me and I should have asked. He says that on the topic of virality in Loom and the metrics being spotty, how did you try and fill in that gap of understanding? And am I right to say you didn't? You just had a gut feel on that one?
Yes, it was like there was not enough data to see that there is a viral coefficient of a certain number. And yeah. I think it's because there are so many different factors influencing this. I think it takes years to really establish a good understanding of that. And I think Mark at Quiller can probably confirm that too. Quiller is an intrinsically viral product as well, but there are so many factors that I think it really is hard to prove the viral loop unless it's so obvious that it's a consumer style product and it just takes off completely. And it wasn't that. It was not. It wasn't. The viral loop wasn't so strong that they would basically double usage every 8 weeks or so. So it wasn't like that. It was more like that we saw some anecdotal evidence of users who have received a Loom then sign up. And just the fact that they've been growing in spite of not having done any paid marketing or content marketing. So it basically told us that the users, they have to come from the viral engine or from organic referrals, because that's pretty much because they didn't do anything else.
I asked Harry Stebbings what to ask you, because I think he's good at asking VCs questions. And he asked, and I don't know if this is interesting to anyone, but it's interesting to me, so I'm going to ask it. He said, "Why do you always do pro rata? It's not rational or logical."
Good question, and definitely especially good if it comes from Harry, who I consider a bit of a. I mean, I don't know if I can call him a friend, because maybe we don't know each other that well, but I have a huge amount of respect for him, what he achieved at his incredibly young age. So just unbelievable. So anybody who hasn't listened to his podcast, it's pretty amazing. He gets anybody on his show, and he's incredibly productive. So
and Christoph, let me interrupt you quickly, because I should frame this question it's even more specific, right? Like, you've written publicly about the fact that you have a commitment to doing pro rata. Yeah. So this isn't even behavior. This is a sort of stated intent.
Yeah, right. Yeah, and so with the thinking behind that was a couple of things, actually. Like, so one was that we looked at when we just looked at what we actually did, like looking back, like in how many times did we take up our pro rata, then we saw that in the majority of the cases, the vast majority of the cases, we did take our pro rata despite the fact that we didn't have to. So that makes the commitment somewhat less painful than maybe it appears on the surface. And then but this was more like the sanity check, like the driving force behind it was that when at a seed stage, you always have these discussions about signaling, right? And for founders, like this uncertainty, whether your existing investors will keep backing you, I think can be quite a burden. So we thought that by just taking that off the table, it would make the lives of our portfolio companies easier, and it wouldn't really hurt us that much on balance, because in most of the cases we would do our pro rata anyway, and we also thought it would be a a nice thing to put out there, right? Like if you raise a seed round from 0.9, you know that you have already secured your pro rata for the next round. So there's one thing less to worry about, and there are still enough other things to worry about. So we thought this is a good way to make the lives of founders easier and improve our value proposition as a fund. And then if it does lead to us every now and then having to invest in cases where we don't want to, we thought that the benefits would just outweigh that. And I think we have, too early to tell, but we're not regretting this at all.
Yeah, no, I think it's a great move. I think more funds should do that. Questions come in from Matt Allen, and I think it relates us back to this conversation at Loom. He's asked, is gut instinct a function of time, experience, or both? And what biases should we listen to in early investments? I wonder if I could layer on something else to that. I'd love you to talk about misses, because clearly you've got, with a bunch of these companies, you've got a superb product intuition. But tell me about the anti-portfolio and what you've learned from that.
Yeah. I mean, the anti-portfolio tends to grow as fast as, or even faster than, the real portfolio. And I think like looking back at some of the companies that we saw early on and could have invested in, or maybe could have invested in, and didn't, and now you see how big some of them become. This is probably the most humbling or humiliating and maybe painful learning experience that you can have as an investor. I don't know how you feel about it, John, but I think not having invested in some of these companies is much more annoying than the other type of mistake, like having invested in a company and didn't work out and you lost some money. The latter is a less expensive mistake.
I want specific examples, Christoph. I want to hear about a specific company you passed on and why and what you learned.
Yeah. So we passed on Pipedrive early on, and then we wanted to correct our mistake, but I think either it was too late then, or we thought the valuation was already too high. But with hindsight, it would have been good to invest like at the seed 2, at the A, pretty much any time, because I think it's a great company. I'm sure a lot of founders listening in right now use Pipedrive as their CRM. They've just raised a huge round at a $1 billion plus valuation. So that's one that we. And
why did you pass? Was it price, or was there something else there?
We think. I think it was a combination. I think when we looked at them the first time, I think it felt just a bit too early, not enough proof that it's really working. Maybe some question marks around like how quickly does a customer outgrow Pipedrive? Like how quickly, or how big is the risk of them losing the customers to Salesforce once they become somewhat bigger? And
so then graduating out the top, you mean they expand and then they churn? That was the concern.
Yeah. And maybe that is an issue still, but I'm sure there are enough companies that stick to Pipedrive. And then I think when we looked at them again, it felt too expensive, and I don't know what the valuation was. Maybe it was, I think maybe 17, 18 or $20 million, which by today's standards is not that high for a company that already had, I don't know, like some level of customers and ARR. And it was very similar with another European company, or at least started in Europe, called TalkDesk, which where we also like we initially we weren't quick enough or convinced enough, and then when we were, then it was already a bit too late, or we felt the valuation was too high. So in both cases we made an initial mistake, and maybe we could have corrected the mistake, but we made a second mistake of not aggressively enough correcting the first mistake.
That resonates completely with me. We run this anti-portfolio analysis all the time, and the theme that comes up again and again is never pass on price. Like if you like everything else, then you usually make that mistake, and then diddle-daddling is kind of second on our list as well. So maybe one day we'll both learn that lesson completely, but it sounds like a common theme.
Yeah.
How do
and
you?
I think then,
sorry,
but I was just going to add. I think it's we think about this a lot, obviously, because we try to learn from our past mistakes, but the feedback cycles are so long that it's so hard to really like train your non-artificial AI, so to speak.
Yeah.
And it's because you also have always pretty or very incomplete information. So even just trying to attribute success or failure to what you saw is hard, because you often even don't know why a company became successful or why it failed to become successful. So I think it's difficult.
Tell me about Point 9 in 2020. You've sort of 5 funds, 12-year journey, a pretty specific focus on B2B SaaS as far as I can observe it for most of that journey. But clearly Pavel's had a couple of aberrations, and you've just backed an artificial meat company. What's your thesis moving forward?
Yeah, so at a high level, at least, our core thesis hasn't changed. We continue to be super excited about B2B SaaS, B2B marketplaces. Obviously, this SaaS industry has already grown tremendously in the last 10 years, probably 10x if you look at the market size, but nevertheless, there are still tens or hundreds of billions of dollars spent on old on-premise software, which we think eventually is going to move to the cloud. And then maybe even more importantly, there is still a huge amount of like non-consumption, non-adoption, like SMBs that run their businesses on pen and paper or using Excel and Outlook. And so I think there are like still like more than enough, like plenty of opportunities to build great B2B SaaS companies. Similarly, for B2B marketplaces, our like somewhat high level thesis is that every industry deserves a marketplace. Like nobody should find their customers or their suppliers by sending faxes and making phone calls and doing everything on paper. So we continue to be super excited about B2B SaaS and B2B marketplaces. That's 90 or 95% of what we do, but we also keep an open mind to new things, whether that's occasionally investing in a consumer internet company when maybe we know the founders already, or when there is some traction, or to invest in companies that do something pretty completely new, like cultivated meat, as you've mentioned, which doesn't really have much in common with B2B SaaS or B2B marketplaces, but it's an area that I started to learn about a couple of years ago, got very passionate about, spent some time digging in, got some other people to help me assess that, because it's very different. It's a very different technology. So we know much less about it. But every once in a while, maybe every couple of years, we make a step outside of our comfort zone. And cultured meat was one of these areas, or is still one of these areas, or crypto, where Pavel spent quite some time in a couple of years ago, and that led to 1 or 2 investments as well. So we want to keep an open mind as well.
Yeah, no, I think that's great. I mean, I think we're investing in the future, right? So being open-minded about what that looks like is a great sign. Christoph, I want to ask an uncomfortable question, but I think it's an important one that both Moira and Sissy have raised in the chat, which is, essentially you and I are both 2 middle-aged white guys that look like what VCs look like, but female founders, as we know, are underfunded, and female investors and just diverse investors more broadly are underrepresented. This is an issue we grapple with in Australia. You would have a sort of global perspective on this. I'd love to hear your thoughts on how we improve that.
Yeah, I think it's definitely a big problem. I think everywhere, as far as I can tell, definitely in Europe and the US. And I think there was a wake-up call for everybody industry, 2 or 3 years ago, in similar timing, or maybe caused by the Me Too movement, and also hearing some really bad behaviors in the tech world, whether that's at tech startups or VC. So I think the awareness has dramatically increased a few years ago, and we have these conversations in board meetings now about diversity in the boardroom, in the company's leadership team, much more frequently than it used to be years ago. But at the same time, the results are not satisfactory, right? We are as a company as a whole, we are pretty diverse in terms of both gender and background, but in the investment team, we only have 1 female, so definitely not the right level of representation there. And it's hard to fix, and anything I would say sounds like an excuse, right? So it's hard. I don't have the right answers. We want to. We would love to have a more gender balanced investment team and partnership, and we're aware of it. We keep our eyes and ears open for future female hires. Like we would love our next hire or our next partner to be a woman. At the same time, we can't completely force it. We don't want to say that the next hire has to be a woman. I think that would also not be the right approach. I think there has been a positive change started a couple of years ago, and also some other VCs have been maybe more successful than we have in adding females in the investment team, also at the partnership level. I don't know I think the positive development has started, but I don't know how long it's going to take until there is a fair 30, 40, 50% representation of women. So I think it's still a long way to go.
Yeah, no, I totally agree. And I don't have answers. I don't have the answers either. One thing we've done recently, which I think is good, it's not a fix, but it's a step, is include a diversity pledge in our term sheets. So if we're leading around now, we've sort of mandated it upon ourselves that we'll include an investor from a diverse background of some description. And that's been great, actually. It's been great because it's opened up rounds that we're leading to new people, but it's also opened us up to a bunch of ideas around this topic that I found really useful. So there's a bazillion things that we all should and could be doing, but that's one that we've at least had some success with.
And any advice on that or suggestions from anybody, please let me know. I'm all ears, because we're honestly struggling to find the right answers there. Like when we do events, we aim to put more women on the stage to show the right examples, and so that that people like women feel like they are not the only ones here. Like we try to push that, and I think it's the right strategy. But we also get occasionally some criticism for that. I think I've also heard like female speakers that we reached out to say, well, I've been on, everybody wants me on stage now suddenly, and they like even ask like, do you want me just because I'm a woman or because of my skills and background? So I'm really honestly struggling to find the right strategy. There are like, it feels like it's just very hard. I'm keen to hear any advice, obviously, particularly from women or people from underrepresented minorities.
Yeah, I agree, and we will open up the comms for ideas. I think it's a great call out. Christoph, I'm just mindful of time, and there's one thing that there's a bunch of things I want to keep talking to you about, but in the 5 minutes that we have, you've been operating remotely for 12 years, which puts you 11 and a half years ahead of most of us. I'd love to hear your kind of lessons learned from investing and supporting companies, and perhaps even observations of remote first companies that will help those of us still adjusting to the pandemic operate better.
Yeah. So I don't know if I have any original insights, especially in just a few minutes, because I think a lot has been written now and shared by people like founders of remote first or remote friendly companies. So I think there is some information out there on all kinds of best practices, right? Like what kind of tools to use or how to communicate and all of that. And I think if you are as a founder or a VC trying to adjust to that model, and you haven't done so yet, then I think you can find a lot of very useful information on online presentations and blog posts with probably more pieces of advice that I can give in a short amount of time. Let me see if there is maybe something to highlight. I mean, I think like previously, before the pandemic, we kind of felt like there are 2 or 3 different types of companies or founder DNAs, and we would never try to push somebody from one to become another, because some founders just love to have everybody around in their office. That's just the way they manage and how they really shine. And then there are others who find it completely straightforward and easy to manage people remotely. And so like pre-pandemic, we were very cautious not to like push people from one model to the other. Now everybody had to adjust to the reality of being a remote company, and the ones that were really dependent on their physical presence in the office and just have that management style, obviously for them it was much harder, and we've seen some companies struggle with that. I think it's not most of them, but some, I mean, I'm assuming we'll come back to some level of normalcy. I don't know what's the right English term there, in maybe sometime next year. But I think the superpower of being able to manage a company remotely is also something that will be valuable even beyond Corona, right? Because it allows you to access bigger talent pools, or I think that's mainly it, right? Like the ability to hire people from different talent pools and find people everywhere in the world. And I think especially if you are not in the Bay Area or maybe London, where you have access to a lot of talent locally, it's hard to find all the right people in in a second or third tier ecosystem. So that ability, I think, is very valuable even after the pandemic.
Yeah, I fully agree. I think that's been, at least for our portfolio companies, I'm on the board of at least 2-3 companies that are now hiring remotely in a way that they never would have, and it's expanded their talent pool immeasurably, obviously, because Australia, as you would expect, has a limited set of expertise. So I think there's challenges and benefits there, but it's something we can lean into. Christoph, I'm going to wrap us up to make sure we actually finish on time. I want to leave you with one piece of feedback, both from the comments in the chat and the comments I got on social media before this. You have clear product market fit in the Saas funding napkin. It would be a shame for all of us if you didn't release a 2020 version, because I get asked on panels all the time about valuation. I hate it when VCs don't answer the valuation question. And my answer up until this point has always been just to parrot your napkin, and I'm going to have to make up an answer if you don't produce it. So please do that.
Point taken. So we'll hurry up to produce the 2020 napkin, even at the risk of maybe a few months later concluding that all it's useful for is actually to use it as a napkin and replace it with a 2021 version.
Hey, Christoph, thank you so much for joining us. The sun has now come up in Berlin, so you can carry on in your day. Really grateful for you taking the time, and it's been great to talk to you. Thank you, John. Thank you, Melissa. Thanks everybody for joining. And if anybody wants to discuss anything that we haven't been able to cover, please feel free to reach out. I'm sure, John, you can make those connections. Of course. Thanks, everyone. We'll see you next time.